Alright, so we need to talk about something that's been on my mind lately. It's been affecting me and other investors, and I think it's something that's going to benefit each and every one of you watching this video today. Right now, I have an urgent warning for all investors stemming from all of the craziness and volatility in the stock market lately. It's negatively impacting a lot of investors right now, which makes this video super important. So all I ask is that you tap the like button if you do enjoy this video or gather any value whatsoever. It does really help me out. And if you haven't already, please consider subscribing so you don't miss any of my future uploads. Also guys, I just revealed a pie chart of my stock portfolio positions and their relative weights within my Discord community of investors, so if you'd like to join today, it's only $1 if you click the link below. But with that said, let's get straight into the video. Alright, so what's my urgent warning for investors right now? Well, to start, let me explain the problem that I'm seeing. Lately, I've seen a lot of comments on my videos as well as videos from other similar YouTube channels where individuals are saying they bought into a stock, it recently started dropping soon after they bought in, and now they're questioning their whole thesis on whether they should hold that stock or they should sell it. Likewise, I've also been seeing comments where individuals will buy into a stock and dollar cost average down to buy the dip, but then as the stock continues dropping further, they hesitate to buy more as it continues falling, and they lose confidence in the stock. Now, I've personally been a victim of both of these scenarios in the past, and they're totally valid feelings to have, so I really think this video is going to be extremely valuable for every single investor watching. Firstly, let's take a look at an example of a company's stock price between the years of 2002 and 2007, then I'll tell you which stock it is in a minute. So within this short 5-year period, we can see that the stock over doubled up from about $15 per share to over $40 per share, which is solid performance. But just imagine for a second that you saw this incredible run up in the stock from 2002 to October of 2003, and because of FOMO, you decide to invest $10,000, being all of your savings at the time, right at the peak of this stock for nearly $60 per share, giving you approximately 167 shares of ownership within this company. Well, unfortunately, little did you know at the time, but this ended up being the absolute worst possible time you could have bought into the stock. And over the next 3 years, the stock price kept falling all the way down to $26.30 per share at the bottom, or a 56% drop in total. At this point, you're sitting there looking at your brokerage account, seeing your position down over $5,500 from a single $10,000 investment, being worth less than half of what it was 3 years ago. Meanwhile, if you had simply invested all of your money into an S&P 500 index ETF over that exact same time period, you would have been up 22% since it was a bull market. There would have been no need to track the company's performance or read any quarterly or annual reports. You could have simply invested the money, forgot about it, and still made gains. Now, I implore you to really try and envision yourself being in this scenario for a minute. It's honestly very demoralizing being a stock picker, seeing your paper losses mount up, and then also underperforming the market at the same time. In fact, this type of scenario makes you think you've wasted so much time and money trying to research stocks and pick stocks individually when you could have just taken the easy route and invested in the market and done so much better. But then for a split second, sitting there looking at the red in your portfolio, you remember what you read in The Intelligent Investor. You decide to ignore your negative emotions and all the red in your portfolio because in the short term, stock prices don't reflect the true value of business anyways. And from there, you buy another lump sum of $10,000 in shares in this stock at $36.63 per share, which now earns you 273 shares of ownership in the company, which isn't even near the bottom of $26 per share. And since you bought at this lower price, that brings your average cost of all of the shares that you've purchased down to $45 per share, which is still far above the current market price of the shares. Well, now let's get back to the stock chart and zoom out a little bit. It turns out that buying the dip was a really good idea, since just over a year later, in December of 2007, your stock is now worth $94.42 per share. Based on your cost basis of $45.45, you over doubled your money, which brought your total position in the stock to $41,545. And over the entire 4-year period from 2003 to 2007, this earned you a compounded annual growth rate of 19.3%. By contrast, how did the S&P 500 end up performing over the same period? Well, in the best case scenario, if you had bought in your entire position in 2003 at the bottom and not even averaged up on your position in 2006, by December 2007, your total return would have been 45%, or 9.4% per year without including dividends. And even after including dividends, it probably would have been a return of about 10 to 11% per year anyways. So investing in the single stock and dollar cost averaging on the way down to basement bargain prices ended up proving to be much more profitable over that 4-year period, even though you were down over 55% at one point during this period. So now I'd imagine you're pretty curious about which stock this is. Well, it's none other than Amazon stock. And if our lovely investor in the example was smart enough to hold Amazon stock until today, his or her initial total investment of $20,000 would now be worth over $1.2 million. Anyways, if we now take a look at how Amazon as a business was performing during this period while the stock sold off over 55%, it was a completely different story. In 2003, Amazon increased its revenue from $3.9 billion to $5.2 billion, which is 33% top line growth. Then in 2004, when the stock started selling off, Amazon increased its revenue from $5.2 billion to $6.9 billion, which is still 31% growth, and they also started generating profits too. Next, in 2005, when the stock continued selling off to even lower prices, Amazon's revenue growth slowed to only 22%, where it grew from $6.9 billion to $8.5 billion. And finally, in 2006, Amazon's revenue growth reaccelerated to 26%, where it grew from $8.5 billion to $10.7 billion. So what's the whole point of all these numbers that I'm trying to show you here? Well, when we zoom out and look at the bigger picture in hindsight, Amazon nearly tripled their revenues over this 4-year span. Meanwhile, their stock price did nothing but fall over this period. So with all that being said, my urgent warning for you is simply this: do not let these short-term stock price fluctuations impact your investment decisions, and also don't let them question the strong conviction you've built up in the wonderful businesses that you already own. This also goes for what the media, your friends, and your family are talking about when it comes to the investments that you own. And by the way, I want to be very clear with what I mean by short-term. As we saw from this example today, Amazon stock dropped for an entire 3 years before recovering. And the same thing happened after the dot-com bubble too, where Amazon stock lost 95% of its value and only started recovering years after it started to fall. So the short term doesn't necessarily have to mean day to day or month to month. It can literally mean a few years at a time. But you know what? This is actually great because it gives investors like you and I the opportunity to accumulate more shares at a cheaper price of all of these amazing businesses that we love. For example, one of my top positions in my portfolio is Trulieve, and it has been dropping for over a year now without respite, and I honestly have no idea when the pain will end. But I do know that investor sentiment can change very quickly in the stock market. So just like Amazon stock over quadrupled in a single year from the bottom back in 2006 to the high of 2007, the same is possible for Trulieve or any other undervalued stock that is continuing to see its business fundamentals grow over time. And the same can be said about Shopify stock, which is down over 60% from just a few months ago, when in reality not much has happened in the business. It's only the macro environment affecting the stock, and because it was quite overvalued before. However, I see a very strong business model with competitive advantages allowing Shopify to gain market share over all of its competitors within the e-commerce space except for Amazon. And even though Shopify's revenue is expected to slow down from 57% in 2021 to 30 or 35% this year, it really doesn't mean much over the long term, as we saw from Amazon's revenue slowdown. We can even look at Tesla stock being down 35% for absolutely no reason, in my opinion, other than negative market sentiment, because I know that the underlying fundamentals of this business have only gotten stronger over this period. And I'm probably starting to sound like a broken record, so hopefully you get the point. Anyways, in this video, I just wanted to give you guys some perspective on some of the stocks that we're seeing crash in today's market and relating it back to how stocks have performed in the past. There's no way that all of the stocks down over 50% right now are going to stay that way. In fact, many of these companies are trading at bargain prices, and they will be much larger companies someday. And just try not to get demoralized whenever your stock prices go below your cost basis and they keep dropping even as you buy the dip. If you flip your mindset into thinking lower prices are good opportunities to continue accumulating shares for less in the companies that you love, you'll do very well in the stock market over the long term. So with that said, if you did enjoy the video today, don't forget to drop a like and subscribe if you have not already. I would really appreciate that. And with that said, I will see you all in the next one.